Understanding the Bond Market, a guide for English language learners. Hello and welcome to our channel. Today, we're diving into an exciting topic that often pops up in financial news: the bond market. If you've ever wondered what people mean when they talk about investing in the bond market or movements on the bond market, you're in the right place. We'll break it down into simple, easy-to-understand segments. Let's get started. The bond market, also known as the debt market or credit market, is a financial market where participants can issue new debt, known as the primary market, or buy and sell debt securities, known as the secondary market. This is where governments, municipalities, and corporations come to borrow money by selling bonds. A bond is essentially a loan made by an investor to a borrower. It's a way for governments and companies to raise funds for various projects or operational needs. Bonds are bought and sold in the bond market, which operates similarly to the stock market. However, instead of owning a share of a company, a bond investor is lending money to the issuer of the bond in exchange for periodic interest payments and the return of the bond's face value when it matures. The key components to understand here are: face value, the amount of money the bond will be worth at maturity, also the reference amount for calculating interest payments; coupon rate, the interest rate that the bond issuer will pay on the face value of the bond, expressed as a percentage; maturity, the date on which the bond will mature, and the issuer will pay back the face value to the bondholder. Investing in the bond market can offer several benefits, including income generation. Bonds typically pay interest regularly, providing a steady income stream for investors. Diversification. Adding bonds to an investment portfolio can reduce risk, as bonds often move differently than stocks. Safety. Government bonds, in particular, are considered low-risk investments because they are backed by the credit of the government. However, it's important to note that not all bonds are created equal. The risk associated with a bond is closely tied to the creditworthiness of the issuer. High-risk bonds, like those issued by companies with poor credit ratings, offer higher interest rates to compensate for the increased risk. The bond market is sensitive to various economic factors, including interest rates, inflation, and the overall health of the economy. For example, interest rates. When interest rates rise, the prices of existing bonds typically fall, since new bonds would be issued at the higher rates, making the older ones less attractive. Inflation. High inflation can erode the purchasing power of the fixed interest payments that bonds provide, making them less appealing to investors. Understanding these dynamics can help investors make informed decisions when investing in the bond market. We hope this video has shed some light on the often complicated world of the bond market. Whether you're an English language learner looking to expand your financial vocabulary or an aspiring investor, knowing about the bond market is a valuable asset. Remember, investing wisely starts with understanding. Thank you for watching, and see you in our next video. This structure should help you create an engaging and informative video that simplifies the concept of the bond market for English language learners.